Hello everyone, this is Dr. Tao's Quant Lab. In this video, we continue chapter 1 with subsection 1.1.2, and we introduce the second major market participation philosophy, price speculation. In the last video, we discussed value investing, which is anchored to an estimate of intrinsic value. Price speculation takes a different perspective. It is anchored to something much more immediate, price behavior itself. Let me start with the definition. Price speculation, also called active trading or technical trading, is a form of market participation that prioritizes observable price behavior over estimates of underlying intrinsic value. Rather than asking what an asset should be worth, price speculation focuses on how prices actually move. Prices move because of supply and demand, sentiment, liquidity, and information flow. The objective is to profit from price movements by anticipating continuation, reversal, or short-term imbalances in market structure. Here is an important remark that I want you to remember. Price speculation does not assume that prices always reflect fundamental value. Instead, it treats price itself as the most immediate and actionable source of information about market consensus, risk perception, and trader behavior. Now let's look at a concrete example. On the screen, you will see a price chart of Tesla. Some stocks exhibit usually high volatility because they attract substantial speculative interest and institutional participation. Tesla is a well-known example. Right, so here's the stock price for Tesla from November 2024 to until now. And you can notice that how large and frequent the swing are. The stock price went down from 488 to 214 and came back to 498 in 1 year. Even if we do not make any claim about Tesla's intrinsic value, the price movement itself creates repeated short and medium-term trading opportunities. Now, this leads to a natural question. What are the main styles of price speculation? There are multiple ways to classify speculative trading, but a practical lens is to classify styles by their structural intent. What type of price behavior one seek to exploit, and their typical holding horizon. Under this lens, three widely used styles are trend trading, swing trading, and day trading. Let's go through them one by one. Trend trading seeks to participate in the sustained directional price movement. The objective is to align with prevailing direction and remain invested as long as the trend structure remains intact. Trade traders emphasize persistence and continuation rather than perfectly timing tops and bottoms. Pullbacks and consolidations are not necessarily failures. They can be normal parts of a trend. A key point. A trend does not require prices to be at all-time highs or lows. Strong trends can emerge at any price level as long as directional structure persists. One common trade continuation signal is a breakout above a prior swing high, or in a downtrend, a breakout below a prior swing low. Okay, so let's see one example. Here's the meta stock price from last year. So meta breaks above prior swing high here around January 24th, 2025, okay, the closing price. And the price continues higher over a period like this. So this illustrates the basic idea. Once a directional structure forms, it may persist long enough to be traded. Okay, so let's back to the notes. So here's the conceptual summary of trend trading. Once a directional price structure is established, it often persists. Common expressions include breakouts above prior highs, continuation after consolidations, and the pullbacks that fell to reserve. In this course, we emphasize objective structure-based evidence rather than simply hoping a trend continues. Okay, so the second strategy, trend trading. This strategy seeks to exploit directional persistence. In practice, success depends less on perfect entering timing and more on disciplined exits when the trend structure weakens or breaks. Let me add one practical observation. Chasing breakouts and cutting losses can be profitable because trends have a rat tail nature. When a trend forms, it sometimes persists longer than expected. The key is to avoid overstaying. Many failed momentum traders misjudge trend duration or ignore reversal evidence. A practical habit is to scale out after entry. Take partial profits as the trend matures, reduce exposure when reversal signals appear, and protect the remaining position with a stop loss or trailing exit rule. We will revisit stopping loss in this chapter. Finally, there is a broader category called macro trend trading, where the primary drivers are macroeconomic focuses. That topic is useful, especially in commodities, bonds, and foreign exchanges. But it is beyond the core scope of this course, so we will not cover it in depth. Okay, next is swing trading. Swing trading focuses on capturing short-term price movements, swings, within broader market structures. These swings can occur within a trend or within a sideways range. Swing traders prioritize exploiting local oscillations and turning points rather than holding positions through an entire trend. In practice, swing trading often relies on structured reference zones where price has previously stalled or reversed, such as support and resistance areas or common retracement zones like Fibonacci retracement. So let's look at one example. So here's the stock price for NVIDIA from January 2025 to about August. And this is the Fibonacci retracement. And we're going to talk about the details later in chapter 2, but here is the breakout uh, around May 13th, 2025. Okay, for this Fibonacci retracement. A swing trader may interpret the subsequent movement towards the prior local maximum as a tradable swing at this box. Okay, so from here to here. Uh, Again, later chapters will formalize this structure concepts and show how we define and use them carefully. Let's back to the notes. All examples I have a screenshot and put them in the lecture notes. So this comes to the third strategy, technical analysis and swing trading. This strategy exploits price oscillations around meaningful structural zones. Consistency depends on technical understanding and emotional discipline rather than trade frequency. I want to be transparent. Swing trading is powerful, but many people struggle because they do not have a structural framework or because psychological pressure prevents consistent excursion. A disciplined process is essential. Now, let's briefly discuss the last types of trading, day trading. Day trading is a speculative style where all positions are opened and closed within the same trading day. The focus is on intraday volatility, short-lived imbalances, and excursion speed with no overnight exposure. Day trading is especially sensitive to excursion quality and noise, whereas trend and swing trading requires greater tolerance for in-term fluctuations and delayed feedback. And let's see another example from Tesla. So this figure shows Tesla intraday movement today, okay, on January 30th, 2026. And we can see that there's the huge increment just within 1.5 hours. So intraday volatility can create opportunities like today, but not every day provides clean setups. Now, day trading is often separated into two practical sub-styles. Scalping targets very small, short-lived price movements on extremely short time frames. It is excursion intensive and mentally demanding, and it is often more suitable for automated or semi-automated setting. Intraday swing trading captures one or few intraday moves while avoiding overnight exposure. Although less intense than scalping, it still demands strong technical skills and disciplined excursion. Let me give one clear caution for beginners. Day trading is particularly demanding. It requires sustained attention, repeat decision-making, and disciplined excursion under time pressure. Beginners are generally advised to gain experience through long horizon speculative styles before attempting intraday trading. To close this video, let's direct contract price speculation with value investing. Value investing is anchored to intrinsic value, fundamentals, and a margin of safety. Price speculation is anchored to price structure, timing, and excursion. You can think of it in this way. Value investors ask, what is this business worth over the long run? Speculators ask, what is the price doing right now? And what is the structure suggesting next? Both approaches can be valid. They suit different personalities, goals, and constraints. Personally, I prefer price speculation, so this lecture notes will primarily focus on it. That said, we will also cover the basis of value investing, including how to analyze financial reports. All right, that concludes subsection 1.1.2 on price speculation. In the next section, we will discuss who trades the market.